Hi there, and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances, and you need to decide for yourself whether it's appropriate to you. Okay, so since we spoke last, since the last market view, the market has shot up a bit higher, actually, surprising us. We finally broke through the resistance levels through here. Okay, so it took a few attempts to get us higher. Okay, over a period of roughly a couple of months. Okay, but we've finally done it. We've shot up, so you can see the longer term trend is staying in play here. That trend's very well established now on the XJO, and until that trend really breaks or we start seeing some really big reversal patterns, my assumption is that this trend is going to continue. Originally, my view back late last year, early this year, is that we were going to break through into all-time highs in the first quarter. Now I was a little bit off on my timing, but I was eventually right in the sense we have finally broken into the all-time high. Look, my prediction is, guys, that we're heading much, much higher over the next 6 months or so. At this point of time, and I've said this many of times, that I haven't seen market conditions this accommodating for equities, right? And I'll talk to this a little bit more as I go through this video, but at the end of the day, between central bank stimulus, between physical stimulus from the governments themselves, it can't get much better than this, really, right, for markets overall. And therefore, I think as a result, we're going to see a period of growth, and that period of growth should help see our market still higher than what it is right now. All right, so nonetheless, though, in the short term, the market has run a bit hot. We are looking a bit overbought from a short-term perspective, so a small period of sideways or a slight pullback here is on the table. I really do hope we pull back to around 72, 71, 70. What that means is we come back near the trend and the market continues to move rather than this sort of sideways action. For a short-term trader like myself, I much prefer this type of movement than the sideways type of movement. I do have strategies in my arsenal to trade the sideways moves using options, but I guess it's a bit more boring as a trader than trading directional movement. There's a lot more profit to be had in directional movement than sideways on our markets. So definitely inviting a pullback here, guys. The market's overdone. I'd love to see it back to 71, 70, 71, 50, something like that. Back to this trend line that I've got drawn here at some point in the next 2 to 3 weeks. But hey, look, we could just end up with a month or so of sideways movement as well. So I'm open-minded. Right now, though, from a trading signal perspective, it's in the edge of an ascending triangle. It will either break high. If it breaks high, we'll look to go long again. If it breaks the trend line, we'll look to either go short or sideways this market. But until then, just really waiting for a few more days to see which way this is going to break. Coming across the US market, so S&P 500 is also starting to be squeezed into the edge of a triangle pattern, but not as right to the edge as what we're seeing ours at the moment. Nonetheless, we've had about 3 goes now at the all-time high over in the US there, and once again, nice big roaring uptrend. At this point of time, I'm not seeing an end to that trend. I'm not seeing a reversal pattern. I'm not seeing anything break down. So really just waiting for that break higher. I suspect a bit more sideways to come until it does break. US reporting kicks in about middle of next month. Usually you start getting a bit of movement closer into that. But this month there is still a little bit to play out for the US, in particular this week. It's the CPI reading, so inflation is a big deal at the moment, as well as the Fed meeting next week. They're the 2 big things, I guess, in the very short term that could move markets. But until that ascending triangle breaks in the short term, look, I just expect a very whippy market. Not much else to say there. So Melbourne restrictions are still in place. It looks like we're going to get another announcement Thursday. We suspect they'll loosen the restrictions a little bit, but I guess we're still not going to be able to travel, or we're not going to see state travel from Melbourne and vice versa for a few weeks yet. But yeah, look, I don't think it's really affecting the market too much at the moment. everyone sees this lockdown as a temporary lockdown, 2-3 weeks, and it'll be done and dusted. So at this stage, two today, 11 yesterday, the numbers are still averaging a little high. I would like to see 2 or 3 days in a row where there's only a couple of cases. I think they'll make everybody feel a bit better. But for now, look, it's not really holding the market back as such. Iron ore has been a little bit all over the place, but it is sitting around 200 a ton still. That's a big price, guys. It's a mammoth price. The commentary around this is all over the place. Some people are calling it up to 250. Some people are calling it back to 180. Look, I feel 180. I'm probably on that side of things. I think it did run a bit hot above 200. I do feel there's a lot of support around that 180 US a ton range. Even at that level, though, our miners, I have to say, is still extremely cheap. If 180 holds or above through the rest of this year, expect a lot more upward movement in our miners, especially coming to the August reporting. Okay, so keep an eye on this space. The material sector isn't done, guys. Especially if iron ore holds up here, if base metals hold up near their highs at the moment, they just have to hold here. And our miners are extremely cheap from a forward price to earnings point of view. I really don't think many of the analysts are pricing in iron ore this high in their forward projections. I heard most analysts actually only 2 or 3 months ago suggesting that iron ore is going to go back to $120, and it was meant to have done that by now. Guess what? We're still at 200. So, look, materials is definitely something to keep an eye on coming into the August reporting. Now, the big thing, guys, overall for the rest of this year, what you need to watch out for is central banks. Okay, so what we're starting to hear over the last few months, and particularly I've noticed a lot more articles surfacing this week, is the Fed being due to taper bond purchasing. Now, we saw a number of Fed officials last week come out and say they believe it's time to start talking about tapering. Okay. Now, obviously, we don't have any set in stone timeline on when they're going to start tapering. The only thing that the Fed has really told us is they won't be increasing rates anytime soon, and they won't be changing their stance until they see a period of inflation. And they're happy to see higher than normal inflation for a period of time because they believe it's only going to be transitory. So, look, what the Fed says and what investors start thinking are two different things depending on what they see in the data. So inflation's particularly important this week. So just keep an eye on that because you might get some knee jerks in the market off the back of that. But overall, the markets won't pull back dramatically for a long period of time until and if the Fed tapers too quickly, right? So what we want to hear from the Fed over the next few months is this. We're not going to taper until towards the end of the year. When we do taper, we're going to taper like this, and it's going to be a slow taper, and we'll increase and we'll continue to taper how many bonds they're buying, depending on how things are tracking on economically. That's the type of noise we want to hear from the Fed. It's going to be a slow, steady taper over the period of a year or two, and they're not going to rush it. If we continue to see strong economic data and the Fed only tapering slowly, I think that's still very bullish the markets. If we see weak economic data whilst they're tapering, the market's going to pull back. And I think that's the key here. I'm not expecting a snap pullback off the back of the Fed announcing a tapering. I'm expecting a little bit of volatility. It might pull back 2, 3, 4%. But overall, the big investors are going to be waiting to see, okay, how's the economy tracking versus the current stance of the central banks? Are they tapering too quickly? Are they tapering too slowly? That's sort of the detail people are going to get into to make decisions on whether they're going to jump out of equity markets or not. The reality is if they can actually achieve higher inflation over a period of time, so let's just say we see a slightly above or slightly on trend inflation, 2 to 3% around that range consistently for a year, well, really we expect equities quite a bit higher than this. As long as central banks don't taper and increase rates too quickly, we should see a good bullish period still ahead before we start worrying about interest rates getting too high, okay, or worrying about bonds being tapered too quickly. So still short term, I think things are still looking very, very bullish, okay. All right, so US stimulus. Look, Biden's still talking more physical stimulus to come. Okay, and that's still, from an infrastructure spending bill that he's trying to push through. Yellen's talking that this bill really is to battle deflationary issues even before COVID kicked in. And there was massive deflationary issues before COVID kicked in. And the inflation that we are seeing right now could just be transitory. It could be just created because we created a low base last year. It could be created from supply chain issues. And therefore, more physical stimulus, it could be definitely needed, right? Especially to see us continue to see strong economic recovery after the COVID last year. Don't forget, strong economic data right now may only look strong because of the dip last year. And when you're comparing from a low base, yes, things could on a monthly basis look strong, but that's going to settle down pretty quickly, guys. Okay, so just you got to look at the detail here. Okay, if you're trying to form a view this way, but nonetheless, more stimulus hitting markets is more bullish, right? If Biden passes his infrastructure bill, I know they're still negotiating around this, and they are delaying it, which is fine because things are tracking on a bit better. Vaccines are being rolled out, economies are slowly reopening anyway. So that would definitely be a strong catalyst for the market. So all in all, I'll just wrap this up here. I know it's a long video, but the market is still a weighing machine right now between stimulus and strength of the economy. We don't want to see the economy grow too quickly because then everyone's going to assume that central banks are going to taper too quickly. So we want to see a slow, steady rebound in the economy, and we want to hear the central banks continue to talk like they're going to taper slowly. Okay, so we were already starting to see some countries taper, like Bank of England tapered a couple of months ago, and it hasn't hit their market in a bad way. So as long as they taper in a healthy way and they continue to communicate that extremely well, I can't see that being a massive negative for the market. If they taper too quickly and they don't explain what they're doing properly, there's some dangers. So one last thing, keep an eye on bond yields. If bond yields start to spike dramatically like we saw a few months ago, that's a warning sign, and you should start looking at whether the market's going to break lower. Okay, that's your warning sign, guys. Just keep an eye on extreme selling in the bond market, which sends yields higher. That's your alarm bells. Okay, so keep an eye on that space. All right, I'll leave you there. A bit to think about, but like I said, I'll reiterate, I've been saying this for a while. I do believe markets are going to continue to head higher as long as nothing dramatically changes this mood in the market right now. All right, thanks for listening in. Take care, and bye for now.